In this video, I am going to speak about the best way to create and manage mutual fund portfolios. I am going to discuss about how to select good mutual funds among the hundreds of mutual funds available in the market and create a portfolio. And once the portfolio is created, how should it be managed? How to rebalance the portfolio and what are the criteria to rebalance the portfolio? And finally, I am also going to talk about how to evaluate the performance if the portfolio is already existing. In order to select the mutual funds for the portfolio, we are going to refer information from two websites. One is valueresearchonline.com and the next one is moneycontrol.com. When it comes to mutual fund, Value Research is one of the popular websites with credible information. The criteria for selecting the mutual fund would be the performance of the mutual fund in the past 5 years and also its Crisil rating. I am in valueresearch.com. I am going to the funds link and then I am just clicking the best mutual funds. Here, this is showing the mutual funds data or performance for the past 1 year. I am going to select 5 years from this drop down and I am going to select direct funds. So I get all this information. I am going to export this information to a spreadsheet so that we can do a better deep dive on these funds. I have opened the downloaded spreadsheet. This has the date and time in which the report is generated. It has all the fund names and the rating of the fund, which is either a 5-star or a 4-star. This rating is given by the Value Research website, and this rating is based on risk adjusted return for these funds. If you need to know more information about how this website comes up with the rating, you can refer the website and get more information. And this for each of the funds, there is also the category whether it is a large cap, flexi cap, mid cap, sectoral funds, etc. And it shows the 1 year return percentage, 1 year SIP return percentage, 1 year lump sum investment return percentage for 1 lakh. It shows similar returns for 3 years, 5 years, and 10 years. And it also shows the riskometer, whether the risk, what is the risk for the fund, whether it is high or very high or whatever, and the expected return grade, whether it is average or above average or high. I'm going to set up a filter here, and we are going to shortlist these funds based on the 5 years past performance. So why are we using 5 years, not 1 year? The reason is that in a shorter term, the performance of the fund may fluctuate and it may not give the right picture. So it is always better to evaluate the performance of the fund on a longer term. So here I am going to use this particular column, 5 years return percentage. And if you are planning to do systematic investments, then you can also use this column, which gives the SIP returns for the same tenure. I am going to sort this column on descending order. So there are some funds which are relatively new and which has not yet crossed 5 years. So I am going to remove all those funds which are relatively new. I am going to delete that from our sheet, and here I get all the funds which have worked for more than 5 years, and I can see the percentage returns. We are going to need 4 or 5 mutual funds for our portfolio, but this list still has around 250 funds. So I'm going to delete all the funds with ranking or rating 4. And after removing this, let's see how much fund do we get. There are totally 75 funds. All these funds are 5-star rated by Value Research website, and based on 5 years return, you can see that these funds at the top have given more returns, and these funds at the bottom have given less returns. So the funds at the top are obviously equity funds, and their risk profile is like very high risk, and the return is high return. So the aim is to create a well diversified portfolio for long term investment, and the number of funds should be less so that it would be easy to manage. Try to have a maximum of 4 or 5 mutual funds in your portfolio, and have just one fund across each categories so that your portfolio is well diversified. You might have to select the fund based on your risk profile. If you wanted to take more risk and if you're expecting more return, go for equity based fund. If you are a moderate risk taker, go for hybrid fund, and if you are a low risk taker, then you can go for dip fund. You should understand the details and nature of the fund before selecting it. So, assuming that you wanted to select a list of equity funds, the first fund that you see here is a sectoral infrastructure fund. So, before selecting the fund, you should know that these sectors are cyclic and they are very volatile. So, it is very much necessary to enter and exit the fund at the right time. If the timing goes wrong, then you may not be able to get the best returns out of this fund. So if you understand about sector rotation, how it works, and if you know about how to track the sector rotation and how to precisely plan your enter and exit based on the sector rotation, then you can go for this fund. Or if you are an expert in predicting the future outlook of the market, and if you feel that for the remaining 5 years as well, this infrastructure sector will perform good, then go for infrastructure fund. Otherwise, go for broad-based funds like the small cap, mid cap funds, which are subsequently in this list. Now let's try to select one small cap fund. For that, I will just filter only the small cap funds here, and I can see that there are totally 3 small cap funds. First, I will do some research on the first fund, and for that, I'm going to use value research. Again, I'm going to search for small cap here. Um, so here there is this fund, Nippon India Small Cap. I am clicking on that link and I see that the value research rating is 5 star, risk is high, 3 years return is 27%, and 5 years return is 37%. And then I can see the performance of the fund for the period mentioned here. The blue line indicates the performance of the fund, and the green line indicates the performance of BSE 250 small cap index, total return index, and then the brown line indicates the performance of all the small cap funds put together. So if you see here, this fund has performed lesser than the index on a shorter term for 1 year. Okay, so this is just for your reference, and you can just check what will be the return based on the investment that you make. If you invest say 1 lakh upfront and then probably 10,000 subsequently in monthly SIPs for 3 years, then your return would be 7 lakh 12,000 after 3 years. If you don't invest this upfront amount, if I make it zero, and if you just put a monthly SIP for 10,000 for 3 years, then your return would be 5 lakh 3,000. This is just to know your returns based on past performance. And you can see the risk rating of the fund. The risk rating of the specific fund is very high, and you need to know about the assets this fund is having. Okay, so the assets is like 95.98% equity allocation, 0.02% in debt, and 4% in cash or cash equivalent. Okay, it is good to have good to see a fund having cash or cash equivalent, because that will ensure that there is sufficient cash available in case if the market goes down. So it will help to buy on dips. And you can also see the market caps of the asset for this fund. 10% of the assets are allocated in giant stocks, 6% in large cap, 47% in mid cap, and 35% small cap. You can also see the portfolio breakdown. So basically, the sectors in which these funds have allocated, and you can see that it has good diversification, right? So you are just investing in one single fund, and you can see that your money goes to industrial sector, finance sector, material sector, consumer discretionary, healthcare, all these sectors. Okay. There are totally 10 sectors, and these are the stocks that this fund has invested. Okay. This changes month after month based on the portfolio churning done by the specific fund manager. And you can also see some of the data related to its peer comparison, and you can see its net assets. This is having net asset worth of 13,995 crore, which is a sizable asset. When you are selecting the fund, don't go for a fund which is having a very less asset size, which is like only like 500 crores or less. This is a very small asset. So that fund might be relatively new, or that fund might be old enough, but it may not be in attracting sufficient investments. So try to avoid those kind of funds with very low asset size. And the next one you will have to check is about the exit load. Okay, so as this description says, this exit load of 1% would be levied if you withdraw the fund before 1 year. Okay. And you can see the minimum investment, which is lump sum investment 5,000. Minimum withdrawal is 1,000 rupees. If you want to invest in SIP, one time investment of SIP per SIP would be 500 rupees. And you can see like to whom it is suitable. Okay, so this fund itself say that the investment should be done on a long-term horizon, and you will also see about the capital gains for this fund, wherein there will be a 12.5% capital gain if you are holding this fund for more than 1 year. So check all these details, and you have already filtered the top performing fund from this website. The next thing that you will have to see is the Crisil rating. To see the Crisil rating, you will have to go to the Money Control website. Here, if you see, the Crisil rating is 4. So for this particular fund, even though the value research rating was 5, the Crisil rating is 4, which means that this fund is showing above average performance among peers. Okay, so let's try to find out how the next fund looks like. I am going to Bandhan fund, Bandhan small cap fund, and will search for the fund name in Money Control. So for this fund, I can see that the Crisil rating is fine, and it shows that it has very good performance among peers. You can find same kind of information in moneycontrol.com as well. So we'll go for a fund that has a Crisil rating 5 rather than going for the previous fund which had a Crisil rating 4. So here I have just highlighted this fund. At the time of creating the portfolio, there were 3 funds in the small cap which are rated 5 star. Among that, I am selecting this particular fund which has a Crisil rating of 5 star as well. Now let's quickly check why it is very important to have Crisil rating while selecting mutual funds. Crisil is a leading organization in India that provides credit ratings for individuals as well as for organization, and it also provides ranking for the mutual funds. Okay, so the mutual fund ranking by Crisil is based on different parameters, one among which is portfolio diversification. So a more diversified portfolio means lesser risk, and Crisil rating also is based on the returns and the volatility. So obviously a mutual fund which has higher returns in the past will be having better Crisil rating than the one that has lower returns in the past, as well as the mutual fund which are having lower fluctuations in return or lower volatility in returns will have better ratings. And Crisil also focuses on liquidity of stocks. So if a mutual fund portfolio has significant exposure to stocks that are not liquid, then the fund may not be able to sell the stocks in time of need, which in turn is the risk for the mutual fund holders like us. And Crisil also checks if the fund has a benchmark index against which the performance of the fund can be measured. So there would be certain funds where it may not have provided the benchmark index. So those kind of funds will not be having Crisil rating, or the funds which are relatively new, which are less than 3 years, or which are not declaring their NAV properly. Those kinds of fund will not be having Crisil rating. So selecting a 5-star Crisil rated fund will automatically take care of all these parameters. If I Google for mid-cap funds, I get a link from Money Control that has the list of all the mid-cap fund along with the Crisil rating. So there are quite a lot of funds. They have the Crisil rating of 1 star to 5 star. So I have summarized the information of funds available in the Money Control website related to mid-cap funds, and I have put it in this table. Here you can see that there are 3 mutual funds with Crisil rating 1, and this shows the average performance of these 3 rated 1 funds along 2 years, 3 years, 5 years and 10 years. Okay. So similarly there are 4 funds with Crisil rating 2, 6 with Crisil rating 3, 4 with Crisil rating 4 and 3 with Crisil rating 5. So if you see here, the returns are consistently higher across all tenures for the higher rated funds by Crisil. It would be better to select a Crisil rated 5 fund to start with and keep a buffer until it goes to Crisil rating 4 or below that, rather than selecting something from the list which has lower return and expecting it to move up higher, overtaking the higher rated funds. Another important aspect to be considered while selecting the mutual fund is to go for direct fund rather than regular fund. The primary difference between direct fund and the regular fund is that the regular fund will have more brokerage charges and the direct fund will have lesser or no brokerage charges. Here is the snapshot of this particular fund from Money Control on 24th of July 2025. If you can see, this is a regular fund and the scheme has given 6.6% return in for 1 year. Okay, and it's within the same fund, this is the direct plan, and for the same year this has given 7.64%. So if you had invested 1 lakh in this fund on a regular plan, your return would have become 1 lakh 6,600 in a regular plan, versus in direct plan your return would have got 1,07,640. Same case, if you consider 5 years, the regular fund scheme has given 35.62% return, while the direct scheme has given 37.16%. Okay, so you would have received 26,000 lesser for 1 lakh invested for a tenure of 5 years if you had gone for a regular fund. So it is very important that you go for a direct fund. Now we have selected one fund from small cap category to be added to our diversified portfolio. In the similar way, you can select one fund from the other categories like mid cap or large and mid cap, value oriented, etc. So by the end of this exercise, you should be having 4 to 5 funds that are distributed across different categories, and the portfolio should be created using these funds. A quick recap on selecting mutual funds and portfolio creation. First, you will go to Value Research website. You will select top rated fund, sort them by past 5 years performance, download the spreadsheet and have it for your future reference. You will select one fund from each category based on your risk appetite. At the end, you will be having like 4 to 5 funds across different categories. The fund should have 5-star Crisil rating and 5-star value research rating as well. Ensure that your portfolio is created with direct fund schemes so that you get better return. Start your SIP or lump sum investment after you create the portfolio. Moving on to portfolio management and rebalancing. Ensure that you are staying disciplined in investing. If your portfolio has equity category funds, then you need to plan for a long-term investment. And if you are in SIP, ensure that you are not breaking the SIP in between. At the end of each year, you have a yearly review to track the performance of your fund. This can be done in a simple way. Just check where your fund stands among its peers. Is it doing good or it's not doing good? Easy and quick way to check it is to check the rating of the fund. So you can check the rating of the fund in both value research and money control for Crisil rating. You should have selected a 5-star rated fund, and if your fund is continuing to stay in the 5-star or 4-star, then your fund is performing good. You don't have to worry about it. You can continue your SIP or you can continue your lump sum investment and stick to that fund. If your fund has moved down to a 3-star or below that, then there seems to be an issue with the fund. Just try to get more information about what the issue is about. The performance of the mutual funds will be mostly dependent on the skills of the mutual fund manager. So it could have happened that the mutual fund manager has changed, or there should have been some issues with the reporting in the fund, so that the rating of the fund has went down, etc. So just try to find out what has went wrong. But if the fund has moved from a 5-star to a 3-star or below, move your money to a better performing fund using the steps mentioned earlier. So the gist of portfolio management and rebalancing: after 1 year, check the performance of the fund. If the fund has moved down to a 3-star from a 5-star, then you will have to move your money to another top rated fund. Repeat the steps at the end of each year so that you travel along with the top performing mutual funds. Now you may feel, what happens if all of my funds are downgraded from a 5-star to a 3-star or below? I'll be a big loser in investment. But just think about it. A 5-star rated fund moving to a 3-star or below, the probability of this happening is very, very, very less. So if you are having 4 or 5 funds in your portfolio, the possibility of one fund in that portfolio to move from a 5-star to a 3-star or below, it can happen. But more than one fund, it is very, very rare case. Don't worry about all of your funds getting downgraded. It is not going to work that way. Moving to existing portfolio evaluation, the evaluation of a equity portfolio or a mutual fund portfolio will be done via two main aspects. One is evaluating the performance of your portfolio against the broad-based indices. Second one is evaluating the quality of stocks or mutual funds in your portfolio. So, coming to evaluating the performance of the funds against broad-based indices, these three indices, Nifty, Mid Cap 150, Small Cap 250, these three are broad-based indices and it represents the entire stock market. These indices has stocks from all the different sectors like auto or say textile or sugar, whatever, and these are meant to indicate the performance of the entire stock market. So if you see this Nifty, the growth of Nifty is 44% since January 2022. It has grown by 105% since January 2020 and 140% since January 2018 and 205% in the past 10 years. If you see the mid cap index, it has grown 89% in the past 3 years, 247% in the past 5 years, 200% in the past 7 years, and 430% in the past 10 years. Nifty small cap 250, it has grown by 79% in the past 3 years, 270% in the past 5 years, and there is no data for this specific index before 2019. So these two are left blank. So if you can see, all this key indices have grown a lot in the past on a long-term basis. So this reflection would also be visible in all the mutual funds. I am in Money Control website and I have selected the large cap funds. If you see here, this is the list of all the large cap funds that are available in the market, and you can see their Crisil rating is 1 star, 2 star, 3 star, 4 star and 5 star. And if you can see the returns from these funds on a longer term basis, say 2 years, 3 years, 5 years and 10 years, you can see green everywhere. Okay, there is not even a single fund that has given negative return on a longer term basis. So this is on large cap fund. Same would be applicable for mid cap fund as well. And this is the list of all the mid cap funds, starting from the top rated fund to the bottom rated fund. And if you see here, on a longer term basis, 2 years and above, okay, there is not even a single red, which means that not even a single fund among the entire list of funds has given a negative return on a longer term basis. So it makes perfect sense to measure the performance of a mutual fund from the portfolio against the performance of these broad-based indices. So in the second table that we are seeing, this shows the return if 3 lakhs is equally split across these three indices. So if 3 lakhs is split across these three indices, 1 lakh would have been invested in all these three indices. So 1 lakh in 3 years would have grown by 44%. So which is 1 lakh 44,000. 1 lakh invested in mid cap 150 would have grown by 89%, which becomes 1 lakh 89,000, so on and so forth. So the corresponding returns, if the investment is done equally across all these three indices, are shown here at the bottom of the table. So 3 lakhs would have become 5 lakh 12,000 by 3 years, and 3 lakh would have become 9 lakh and 17,000 by end of 5 years, and the corresponding percentage for this return would be like 70.6% in 3 years, 205% in 5 years, 170% in 7 years, and 317% in 10 years. The performance of your portfolio can be measured by comparing your portfolio returns against the percentage returns of these benchmark indices shown here. You will have to consider the entire amount invested in your portfolio, and say if you have invested 10 lakhs in your portfolio, and if your 3 years return in the portfolio is greater than 70.6 percentage, then you are doing good. You have outperform the benchmark indices. Similarly, for a 5 year period, if your portfolio has grown more than 205 percentage, then you are good. Same for the 7 years and 10 years, you can see the returns here. So if your portfolio return is greater than the indices return, then your portfolio management is good. Okay, so if you have reached at least 70% of the indices returns, then your portfolio performance can be rated as okay. Okay, so which means that if your portfolio return is between 50% to 70% in a 3 years, and it is 140 to 205% in 5 years, then you are doing okay in your portfolio, but there is scope for improvement. If your portfolio has grown less than 70% of the indices returns, then definitely you need to check on rebalancing your mutual funds in the portfolio. This data is taken as of 25th July 2025, and this can be applied even to stocks and mutual funds in equity category. In case if you are following a financial advisor for managing a portfolio, the expectation is that your portfolio should be in good status or at least in okay status. But if it is in the needs rebalancing status, then you have to consider switching to a better financial advisor. Here are some common mistakes that should be avoided. The first one is related to maintaining a stagnant portfolio. So this happens because you either fall in love with the fund, you like a fund very much because it has been performing good, so you continue to keep invested in this fund, but you will have to check what is the performance of other funds in the same category. Um, or you just ignore the fund, you get busy with other work activities, and you just leave the fund as it is. The next one is not staying invested long enough. If you are selecting mutual fund, your investment horizon should be in at least for 5 years or 7 years. Okay. SEBI says that more than 50% of the mutual funds are withdrawn within the first year. So this is a huge mistake done by many retail investors. And the next one is about the next one is either having a over concentrated or over diversified portfolio. If you are having a mutual fund portfolio, make sure that it is having like 4 or 5 mutual funds and not more than that. If you see the details of the mutual fund, the money from one mutual fund goes into um, multiple stocks. So already it is diversified, and if you um, and you are further diversifying it in order to reduce the risk by choosing funds from different fund categories. So this should be good enough. If you are maintaining more funds, then it will be difficult to manage those funds. The next one is you would have chosen a sectoral fund at the wrong timings. Okay, so for the sectoral fund, the entry timings and the exit timing is very important. Next one is not investing regularly in case of SIPs. And the last one, which is very important, is not evaluating the fund's performance against benchmark indices or its peers. This can simply be done by the method that I had stated now, and by staying invested in 4 and 5 star Crisil rated funds. You might have done one or more of these common mistakes. If your portfolio is in okay or needs rebalancing status, in that case, just try to fix that one major mistake that would have the most positive impact in your portfolio. Coming to booking profits, if your mutual funds are in good profits, then try to diversify your portfolio. You can create a systematic withdrawal fund in your profitable mutual fund and create a SIP in gold base. If the size of your portfolio is big, then try to have at least 20% of your portfolio in gold so that it is well diversified. Gold has the tendency to go up when the market goes down. I have never seen any analysts giving a negative outlook on Indian stock markets. The stock markets has grown more than 300% in the past 10 years, and the outlook is bullish. So it is expected to grow in the same way. The other thing that you can do is to book partial profit in your mutual fund and switch over to debt funds. Debt funds will have assured returns, but the returns would be relatively low. Market was in bullish phase until last October, and then from then on it has been in a bearish to neutral phase. So this is the cycle of the market, and market may go down further on a shorter term. So if you just have some of your funds in debt funds, you will be getting around 8% or so interest using that fund. And when the market goes down, you can invest and get better returns out of it. So finally, don't take the money out of the system unless there is a desperate need. Hope you found this video useful. Good luck with your investments. Thank you very much.